Before we break this down, this isn't financial advice for your portfolio. It's my analysis for educational purposes. Michael Burry just liquidated almost his entire portfolio and made the most aggressive bearish bet we've seen since 2008. And if you're holding stocks right now, you need to understand what's happening before it's too late. The man who predicted the housing crisis and made $700 million while banks collapsed has done something that hasn't been seen in 17 years. He sold 12 out of 13 stocks he owned and bought massive put options betting everything will crash. But here's what nobody's telling you. The actual numbers are far more terrifying than anyone realizes, and by the end of this video, you'll understand exactly why your money might not be safe where you think it is. Let me show you the exact filing that just came out. In his latest SEC disclosure, Burry's portfolio went from holding diverse stocks to being concentrated in one single type of investment, put option. These aren't just casual bet, these are nuclear level positions. His put options on Nvidia alone are worth $97 million. That's 49% of his entire fund. Think about that. The stock everyone says you must own for artificial intelligence. The company that made early investors millionaires. And Burry is betting nearly half of everything he manages that it's gonna fall hard. But wait, because it gets worse. He also loaded up on massive put options against Chinese tech giants, Alibaba, Baidu, and JD.com. These are companies that were supposed to be unstoppable. And Burry's betting billions they're all going down together. Now here's where you need to pay close attention, because this next part changes everything. The only stock Burry kept was Estee Lauder, the makeup company. At first that sounds insane, right? Why would someone betting against the entire tech sector keep a cosmetic stock? This is where most people miss the genius of what Burry's actually doing. There's an economic principle called the lipstick index. During the 2001 recession, economist Leonard Lauder noticed something strange. When people couldn't afford big purchases like houses or cars, they still bought small luxury, a new lipstick, a nice perfume, something to make them feel better without spending. Burry increased his position in Estee Lauder to 200,000 shares worth $13.2 million. That's not a growth play, that's a survival strategy. He's not just betting the market will fall, he's positioning for what happens after it crashes, when people are broke but still want to feel human. But the real story isn't just about what Burry sold, it's about when he started selling and what that timing tells us. Burry began dumping his Chinese holdings late last year, and instead of just moving to cash, he went aggressively short with put options. This is critical to understand. Put options expire, they lose value over time even if you're right about the direction. The fact that Burry chose put options instead of just selling and holding cash means he expects a sharp, brutal crash, not a slow decline. He expects it to happen fast enough that these time-sensitive instruments will still be massively profitable. And here's the part that should terrify you. Nvidia fell 30% earlier this year, dropping as low as $86 per share before rebounding. Burry may have already cashed out some of those positions for enormous profit, but the fact that he's still holding or may have reloaded means he thinks there's more pain coming. Let's talk about what Burry sees that most investors are completely missing. First, valuations are insane. Technology stocks are trading at prices that assume not just growth, but exponential growth forever. Companies like Nvidia are priced for perfection, assuming AI will grow without any obstacles, competition, or slowdown. That never lasts. History shows us that every time a sector gets this expensive, reality eventually catches up. But there's something even bigger happening that nobody's talking about. JP Morgan CEO Jamie Dimon, the head of America's largest bank, stood at the Reagan National Economic Forum and said government mismanagement could kill us. He warned specifically about a crack appearing in the bond market. When the most powerful banker in America starts using words like crack in the bond market, that's not casual conversation, that's a 5-alarm warning. Let me explain why this matters to your money. A crack in the bond market happens when investors lose confidence in the government's ability to pay back its debt. When that happens, they sell bonds, yields spike, and borrowing costs explode for everyone, including the government itself. Right now, the United States has to refinance $9.2 trillion in debt in 2025 alone. That's not a typo. $9.2 trillion. Over the next 4 years, it's $28 trillion that needs refinancing. If bond yields keep rising because investors are scared, every dollar of that debt becomes more expensive to service. That means higher interest rates on your mortgage, your car loan, your credit cards, everything. It also means less money for government programs because more of the budget goes just to pay interest on existing debt. As of December 2024, U.S. debt hit 124% of GDP. Historically, when countries reach 130% debt to GDP, 98% of them default on their bond. America is racing toward that line right now. The bond market already showed us what panic looks like. After Trump announced massive tariffs on Liberation Day in April 2025, both stocks and bonds crashed together. The 10-year Treasury yield fell initially to 3.86% as people sought safety, but then something unprecedented happened. The bond market crashed too, sending yields soaring to 4.5% almost overnight. The 30-year yield jumped 54 basis points to 4.92%, its biggest three-day surge since 1982. When both stocks and bonds fall together, there's nowhere safe to hide. That's not a correction, that's a systemic crisis. Japanese bond yields hit 21-year high. British bond yields reached levels not seen since 1998. Global markets were in full panic mode. This is the environment Burry is positioning for when traditional safe havens stop being safe. Here's what makes this even more dangerous. Every bear market since 2009 has been saved by the Federal Reserve pumping massive liquidity into the system. The COVID crash in 2020 was the fastest bear market and fastest recovery in history because the Fed could print money without consequences. But here's the problem. They can't do that anymore. Inflation is still elevated, and if they print money now, it will explode. The Fed's hands are tied. They have to choose between saving the stock market or controlling inflation, and so far, they're choosing inflation. That means when the next crash comes, there's no rescue coming. That's why Burry's positioning is so aggressive. He knows the Fed can't save this one. Let's look at what happened in Q1 2025 specifically, because this is where things get really interesting. Burry liquidated everything except Estee Lauder. He sold Molina Healthcare, which was 10% of his portfolio, HCA Healthcare, Bruker Corporation, and every other long position he held. The timing is crucial here. These sales happened before Trump's Liberation Day tariff announcement and the massive sell-off that followed. Burry positioned defensively before the crisis hit. That's not luck. That's someone who sees what's coming and acts before the crowd panic. And then, in Q2 2025, something fascinating happened. Burry completely closed out those massive bearish put positions from Q1 and rebuilt his portfolio with new holdings. He now holds stocks like Estee Lauder, Lululemon, Bruker Corporation, Regeneron Pharmaceuticals, and Mercado Libre. His portfolio value jumped from $199 million to $578 million. That's a massive repositioning. He went from maximum defense to selective offense in specific companies he believes can survive what's coming. But here's what you need to understand about how professional investors like Burry actually operate. They're not making one directional bet. They're playing chess while everyone else plays checker. When Burry loaded up on put options in Q1, he wasn't just betting on a crash for profit. He was buying insurance. Those put options hedge his other position. If the market crashes, his puts print money. If the market goes up, he loses on the puts, but makes money on his long position. It's a sophisticated strategy that lets him sleep at night no matter what happens. But the fact that he went so heavy on puts in Q1 tells you he was genuinely worried about systemic risk, not just normal volatility. Now in Q2, he's rebuilt with specific stocks he thinks can weather the storm. These aren't random picks, each one serves a purpose. Estee Lauder for the recession lipstick effect, Lululemon for premium athleisure that wealthy people still buy, Regeneron for healthcare, which is recession resistant, Mercado Libre for Latin American e-commerce growth outside the US system. The real question everyone should be asking is, what does Burry know that we don't? He's not just some random investor making guesses. He's a guy who spent months reading through thousands of pages of mortgage documents in 2005 when everyone else was partying. He saw the housing crisis coming because he did the work nobody else would do. Now he's sounding the alarm again, and most people are ignoring it just like they did in 2007. Here's what the data is screaming at us. The US added only 22,000 jobs in August 2025, and job growth has been cut in half compared to 2024. Consumer confidence is cratering, with only 22% of investors feeling optimistic about the market compared to 53% last July. The Buffett Indicator, which measures total stock market value against GDP, is at 191%. Warren Buffett himself said anything over 130% means stocks are overvalued and dangerous. We're at 191%. That's not just overvalued, that's bubble territory. And here's the part that should really concern you: the market already crashed once this year. From mid-February to mid-March 2025, the S&P 500 fell 10% and the Nasdaq dropped 14%. That was just a warning shot. Burry positioned defensively before that crash, then repositioned afterward. He's now holding companies he thinks can survive the next leg down, because make no mistake, he clearly believes there's more coming. The concentration of market gains in just a few AI stocks is another massive red flag. Nvidia alone accounts for over 8% of the entire US stock market and 4% of world GDP. When one company becomes that important, it creates systemic risk. If Nvidia stumbles, everything falls. That's not diversification, that's concentration risk on steroids. And Burry's betting big that AI valuations are unsustainable. The hype is massive, but many companies investing billions in I haven't seen any real financial returns yet. Eventually, reality catches up with hype. Now, let me tell you what most YouTube finance channels won't explain, because they don't actually understand how markets work. The bond market is the boss, not the stock market. Stocks get all the attention, all the headlines, but bonds control everything. When bond yields spike, borrowing costs rise for everyone. Companies that relied on cheap debt to buy back shares and boost stock prices can't afford to anymore. Commercial real estate that was financed with low rates suddenly can't refinance. Banks holding long-term bonds at low yields see the value of those holdings collapse. This is what killed Silicon Valley Bank and triggered the regional banking crisis. And it's about to get much worse. The US needs to roll over trillions in debt at much higher interest rates than when that debt was originally issued. Every percentage point higher in yields costs taxpayers hundreds of billions in extra interest payment. That's money that can't go to infrastructure, defense, social programs, or anything else. It just disappears into interest payments to bondholders. There's also the geopolitical dimension that nobody wants to talk about. China is the second largest foreign holder of US government debt. If US-China tensions escalate further, which they are with all the tariff wars, China could strategically start unloading US Treasury. They won't dump everything at once, because that would crater their own holding. But even a gradual sell-off would push yields higher and make America's debt situation worse. Japan holds even more US debt than China, and they're facing their own economic crisis with inflation at levels not seen in decades. If Japan needs to sell US Treasuries to deal with domestic problems, that's another source of selling pressure. These are the dominoes Burry sees lined up, and he's betting they're about to fall. So what does this mean for you and your money? First, understand that being in cash isn't necessarily safe either, because if inflation spikes again, cash loses purchasing power. That's the trap most people fall into. They think cash is safe, but inflation silently destroys it. Burry's strategy shows us that you need to think about specific positions that can survive chaos. Companies with pricing power that can pass inflation cost to customer. Healthcare, because people need medicine regardless of the economy. Selective consumer staples that people buy even in recession. This isn't about getting rich quick. This is about not getting destroyed when the system breaks. Burry isn't trying to time the exact top. He's positioning for a range of outcomes. If the crash comes, he's protected. If it doesn't come immediately, his long position still works. That's the smart money approach. Prepare for disaster, but don't bet everything on one outcome. The most important lesson from Burry's moves is that contrarian thinking requires courage. In 2005 through 2007, Burry's investors sued him, demanded their money back, and called him crazy for shorting the housing market. He lost clients, faced enormous pressure, and watched his positions lose money for 2 years. But he was right, and when the crash came, he made a fortune. He's willing to be early, because being early and right is better than being on time and wrong. Most investors can't handle that psychological pressure. They need confirmation from others. They need the crowd to agree with them. Burry doesn't care about the crowd. He cares about what the data says. And right now, the data is saying danger ahead. Here's the reality that nobody wants to face. The next crisis won't look exactly like 2008. It never does. In 2008, it was housing and subprime mortgages. This time, it could be corporate debt, government debt, AI valuations, or all of the above at once. The common thread is leverage. Too much debt, too much optimism, and too many people assuming things will keep going up forever. Burry's portfolio is a warning label written in neon light. He's not just making a bet. He's taking out insurance policies and positioning for chaos. The question you have to ask yourself is whether you're going to pay attention to the guy who was right about the last crisis, or whether you're going to assume this time is different. History suggests it's never different, only the details change. The final piece of this puzzle is understanding that market crashes don't happen in a straight line. There will be rallies, moments where it looks like everything's fine, days where stocks surge and everyone thinks the worst is over. Those are called bear market rallies, and they've happened in every major downturn in history. In the Great Depression, there were multiple rallies where stocks gained 30 or 40%, and people thought the bottom was in, only to see stocks fall even further. Burry warned about this exact thing in September 2022, posting historical data showing that 5 to 10% gains are common during bear market. The market tricks you into thinking it's safe, then pulls the rug out again. That's why he went to cash and put options rather than trying to ride it out. He's not willing to gamble that the rallies will last.